Hi, this is Nate Williams, and today we are talking about legal and smart tax deductions. Now, everybody gets excited about tax deductions, but the truth is that most things that are tax deductible, if you spend money on them, will reduce your wealth. So you got to be careful about buying things just because they're tax deductible, and in fact, what you buy. Remember, the goal is to build wealth, not minimize taxes. We're going to do an overview today on what it means to be tax deductible. Getting something via a tax deduction or getting a tax deduction for something you buy is like buying that thing on sale. Now, many of you already understand this, but some of you don't. So, a quick overview. Let's assume that my income is $100,000. And let's say I buy something for $20,000. That's tax deductible. That would reduce my taxable income. So my net income or my taxable income would be $80,000. If my tax rate is 25%, my total tax becomes $20,000, which is 25% times the 80,000. As opposed to if I didn't buy anything and my income were the full 100,000, my tax would be $25,000. So by buying this $20,000 item, it saved me $5,000 in taxes, or 25% of the purchase price of the item. Another way to think of this is the net cost of that item was the $20,000 less the 25% tax savings for a net cost of $15,000. So a couple of important takeaways. First, getting a tax deduction doesn't save you money. It still cost $15,000 to buy this thing. A lot of people think that if I buy something for $20,000 and it's tax deductible, it's going to lower my taxes by $20,000. That would assume that you're in a 100% tax bracket, which doesn't exist. Buying it with the tax deduction, again, is like getting it on sale. The sale rate is your tax rate, your marginal or the tax bracket that you're in, not your effective or average taxes. Remember, and I've got to say this again, as a financial planner, somebody who's trying to help people build wealth, you don't win by paying less in taxes. You win by building wealth and becoming financially free. Now I want to talk for a minute about what it means to be a tax deductible expense. According to the IRS, to be deductible, a business expense must be both ordinary and necessary. By ordinary, the IRS means that an expense is common and accepted in your industry. A necessary expense is one that is helpful and appropriate for your trade or business. Notice that an expense doesn't have to be indispensable to be considered necessary. Now, most of you don't know this, but on your business tax return, the tax preparer or practice financial group, if you work with us, is required to put an industry code. And that tells the IRS what industry this business is in. And so when it's looking at all of the expenses on your tax return, it's comparing that to what it thinks would be ordinary and necessary for your industry. So here's some examples. Wage expense for your dental employees, absolutely ordinary and necessary for your business. Dental supplies or rent for your building, also both ordinary and necessary. Here are some expenses that I think are neither ordinary nor necessary. First one would be a gun to protect your office. Now, you might want to buy a gun anyways to protect your office. That's not my decision to make. But what I'm saying is it's neither an ordinary nor a necessary expense and therefore wouldn't be tax deductible. Country club dues, even if you meet new patients there, are not ordinary nor necessary. Lululemon yoga pants used for when you pay bills on Saturday. Now, I'm not saying to not have the pants. I'm just saying that they wouldn't be considered ordinary or necessary for your line of business and therefore not tax deductible. Hope that's helpful.